Are non-residents subject to personal income tax in France?
Subject to the tax treaty between France and the country of residence, a non-resident may be subject to French personal income tax if he or she receives income from French sources, such as real estate income when the property is located in France, income from professional activities carried out in France, or capital gain and pensions when the pension fund is based in France. Each year, a personal income tax return must be submitted online to report French sources income. The deadline for filing this tax return is usually mid-May, in order to declare income received in the previous year. Even if the income is subject to a withholding by the employer, for employees, or by the pension fund, for pensioners, it must be reported each year in the annual personal income tax return. When filing the personal income tax return, the non-resident can choose between two ways of taxation. Either to be taxed at the average rate calculated on its worldwide income, meaning French and non-French income. As for French residents, this average is calculated using the progressive income tax scale, dependent on the tax household, called quotient familial. After calculation, this average rate is applied only to the French income, or the non-resident can choose to be taxed at a minimum rate of 20%, up to 27,000 euros for French income, and 30% for income above this threshold, without taking into account other foreign income. This solution is simpler to implement because only French income need to be notified to the French tax administration. The competent tax office for non-resident is the Non-Resident Tax Direction. This is a specialized tax office with English-speaking staff. All non-residents with French tax obligations must be registered with the French tax authorities and obtain a French tax identification number in order to be able to submit a personal income tax return online. However, even if the income is taxed in France, it is strongly recommended to contact the tax authorities in the country of residence to fulfill any local reporting obligations. If the French income is also taxed in the country of residence, double taxation can be eliminated under the tax treaty signed with France.